So what if I told you there's a company out there with absolutely explosive, near 60% revenue growth that's getting completely hammered by the market? Welcome to Iron Financial, the show where we forge stronger portfolios by stress testing companies and cutting right through all the noise. Today, we're putting HIMS and HERS Health, ticker HIMS, directly under the microscope. We're going to figure out if this is a massive buying opportunity built on a solid foundation, or if it's a dangerous value trap that's really just a fancy facade. Let's get right into it.
Okay, let's dive right into the core of this whole thing. The entire debate around HIMS, it really boils down to this single glaring paradox that has Wall Street completely split right down the middle. On one hand, you have absolutely blistering top-line growth. I mean, we're talking about a 59% year-over-year jump in annual revenue. Now, in any normal market, a number like that sends a stock straight to the moon. But that's not what's happening here. Not even close. To the moon? Come on. This stock has been a lead balloon for investors. It's been languishing near its 52-week low. I mean, it's been a brutal, brutal fall from its highs. This looks like a classic case of growth for growth's sake, and the market is practically screaming that it isn't buying it. So while the company is out there bragging about the top line, my big question is about the bottom line. Is any of this actually profitable growth, or are they just setting piles of cash on fire to make the revenue number look good?
And you know what? That is precisely what we're here to stress test. We're going to put HIMS through our 5-part analysis. First, we're going to tackle the paradox. Why is there this massive disconnect between revenue growth and the stock's performance? Then, we'll really explore the bull case. What is the engine driving this incredible expansion? After that, we'll dig deep into the bear case. Where are the cracks in the foundation? Then, we'll look at what the company is telling us about the future through its guidance and insider actions. And finally, we'll deliver our verdict. Is this an opportunity, or is it a trap?
All right, let's start with the bull case. And let me tell you, it is built on a foundation of pure, unadulterated growth. We're talking about a company that is on track to do over $2 billion in revenue this year. The strength here is it's undeniable. When you see numbers like these, you're not just looking at a spreadsheet. You're witnessing the heavy lifting of a hyper-growth company executing at a very, very high level. The demand for their products is real and it is massive.
$2.35 billion. Just let that number sink in for a moment. This isn't some speculative startup with a good story and, no sales to back it up. Not at all. This is a major player in the telehealth space, and they are operating at a significant scale. This number right here proves that they have found a massive product-market fit that is resonating with millions and millions of people. It's a powerful statement of market dominance and brand presence.
And this chart, well, it brilliantly illustrates the sheer force of their momentum. A 59% year-over-year growth rate is almost unheard of in this market, especially for a company that's already doing over $1 billion in sales. I mean, most companies would kill for half that growth. Think about it. They added nearly $1 billion to their top line in just 12 months. This is the kind of explosive power that can create enormous shareholder value over the long haul. This is the engine of the entire bull thesis.
Now, the really crucial point here is that this isn't just a domestic success story. The US is the bedrock, no doubt, growing at a phenomenal 53%. But just look at the international numbers. A staggering 399% growth. This isn't just about adding a few more dollars to the top line. This is the proof of concept. They are proving right now that the HIMS model can work anywhere in the world. And that, right there, dramatically expands their total addressable market and gives them a much, much longer runway for future growth. So you might be asking, what's fueling this revenue engine? Well, it's a massive and growing subscriber base. 2.5 million people are paying HIMS on a recurring basis. Now this is the real magic of the subscription model. It creates predictable, recurring revenue that investors absolutely love because it's stable and it's high margin. It also gives HIMS a direct relationship with its customers, which is incredibly valuable. It lets them upsell and cross-sell new products and services, which just keeps increasing the lifetime value of every single customer.
And make no mistake, this is not a one-trick pony. This isn't just the HIMS show anymore. The HERS brand is becoming a juggernaut in its own right, on track to become a billion-dollar business all by itself. Plus, they're rapidly launching new offerings. We're talking testosterone, menopause treatments, at-home lab tests, you name it. They're building a one-stop shop for health and wellness, a complete ecosystem. And that is a powerful competitive advantage that creates a deep moat around their business.
Whoa. Hold on a second. A beautiful structure, you say? A powerful advantage? I see a beautiful facade, but what's it built on? Sand? This growth is impressive on the surface, I'll give you that. But growth at any cost is a recipe for disaster. While you're busy admiring the skyscraper from the outside, I've been down in the basement looking for cracks in the foundation. And let me tell you, they are not hard to find. The bear case is simple.
This company is obsessed with growth and has completely forgotten about profit. Okay, here it is, the first major structural crack, gross margin. In 2024, they had a very healthy 79% gross margin. Pretty good. 1 year later, it's down to 74%. That's a 500 basis point drop. For anyone new to this, a basis point is just 1/100th of a percent. So we're talking about a full 5% drop in profitability on every single dollar of sales. This is a huge red flag. It means that for every single new dollar of revenue they're bringing in, they are keeping less of it as actual profit. This is the very definition of low-quality, unprofitable growth.
And hey, you don't have to take my word for it. This is a direct quote from their own earnings report. They are literally telling you that their main growth drivers, international expansion, new products, the big weight loss category, are the exact things that are killing their profitability. It's like they're trying to fill a leaky bucket by just pouring more and more water into it faster. The strategy itself seems to be fundamentally flawed. It just doesn't feel sustainable.
Now, let's look at the second, and I'd argue more damning piece of evidence, free cash flow. This is the lifeblood of a business, all right? It's the actual cash left in the bank after all the bills are paid. This isn't some fuzzy accounting metric, this is reality. In 2024, they generated a solid $198 million. A year later, it collapsed by over 70% to just $57 million. Folks, this isn't a crack, this is a 5-alarm fire. A 70% drop is catastrophic. This company is burning through cash at an absolutely alarming rate.
And somehow it gets even worse when you zoom in on the most recent quarter. Just look at this number. They didn't just generate less cash, they actually lost money. They lit $2.6 million on fire in just 3 months. For a company that's supposed to be growing this fast, it should be a cash-generating machine. Instead, in the last quarter, it was a cash incinerator. This is a terrifying prospect for investors because it suggests the business model might be fundamentally unprofitable at its core.
And this slide right here, this is the whole bear case in a nutshell. More revenue, less profit. It is as simple as that. In the fourth quarter, revenue grew by a healthy 28%. Sounds great, right? But their net income, their actual bottom line profit, fell by 21%. Let me say that again. They brought in over $130 million more than the same quarter last year and somehow managed to make over $5 million less in profit. This is a company running on a treadmill to nowhere.
Okay, you've definitely pointed out some serious cracks in the foundation. I'm not going to argue that. Margin compression and collapsing cash flow are not things to ignore. But remember, a stock's price is a bet on the future, not just a report card on the past. So now we have to put on our detective hats and look for clues about where this company is actually headed. We need to analyze the signals management is sending and, just as importantly, how the market is reacting to them.
All right, let's start with the loudest signal they sent, their guidance. For a growth stock like HIMS, guidance is absolutely everything. The entire valuation is propped up by the promise of future growth. So what did they say? Management guided for Q1 revenue to be somewhere between $600 and $625 million. Wall Street was expecting over $650 million. That's not a small miss, it's a huge shortfall. This is management basically admitting the growth story is slowing down. And the moment that story starts to crumble, investors flee for the exits. That's exactly what we saw happen here. But hold on, that's not the only signal. The board just authorized a massive $250 million stock buyback. A company doesn't do that unless it believes its own shares are deeply undervalued. That's the board putting shareholder money where its mouth is. It is a massive vote of confidence in the long-term health of the business. Confidence? Or a desperate attempt to prop up a falling stock price? Come on. While the company is buying stock, what are the insiders doing? You know, the executives who know the business better than anyone? They're selling. They sold nearly $3 million worth of their own shares. So which signal do you think is more credible? The company using its cash to create some artificial demand for the stock? Or the insiders quietly cashing out? Talk is cheap. Insider selling speaks volumes.
And this is precisely why Wall Street is so torn on this name. You can see the confusion right here on this chart. You have an almost perfect even split between the bulls and the bears. 4 analysts say buy it, 4 say sell it, but look at the dominant rating, the big one. With 9 analysts, it's hold. And we all know hold is Wall Street code for we have absolutely no idea what to do with this thing. It's basically a shrug and a suit. When you have this much disagreement among the so-called experts, it tells you one thing. The path forward is completely uncertain, and uncertainty is not a recipe for a sound investment.
So we've laid out all the evidence, the good, the bad, and the really ugly. We've seen the fortress of growth, and we've seen the deep cracks in the foundation. So now it's time for the final showdown. Is the market unfairly punishing this stock, creating a generational buying opportunity? Or is this just a house of cards on the verge of complete collapse?
Look, the bull case is ultimately a bet on management's long-term vision. They put a stake in the ground for 2030, $6.5 billion in revenue and over $1 billion in adjusted profit. They're telling you, loud and clear, that they're playing the long game. They're telling you that the current margin pressure and cash burn, that's a strategic investment to build a global titan. If you believe in their ability to execute that vision, then the current weakness in the stock is an opportunity.
So, let's sum up the bull thesis. It's simple. 1. Massive, undeniable growth that proves product-market fit. 2. A proven global expansion strategy that unlocks a huge new market. And 3. A management team that's all in with a huge buyback. This is the steel frame of a skyscraper being built. And yes, it's messy and expensive right now, just like any construction site. But the current stock price is pricing in all of the fear and absolutely none of the long-term opportunity.
And the bear case is an equally clear warning. 1. This is a company that is bleeding cash and profitability. 2. Its growth is unprofitable and, according to their own guidance, it's unsustainable. And 3. The insiders, the people with the most information, are telling you everything you need to know by selling their own stock. This isn't a steel frame being built, it's a fancy facade hiding a weak and crumbling foundation. The market is punishing the stock because it sees the rot underneath the surface. So there you have it. The bull case sees a steel frame being erected for the future. The bear case sees a fancy facade that's about to crumble. One set of facts, two completely different stories. The future of HIMS and HERS hangs in the balance, and it's ultimately up to you to decide which side you're on. Are you betting on the long-term vision, or are you running from the short-term reality? You have the data. Now you have to make the call. That's all for this explainer. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional